Hi everyone. This video will explain everything you need to know about bonds. Bond investing explained. If you've ever wondered how bonds work, why investors hold them, and how they fit into a portfolio, you're in the right place. Today, I'll walk you through everything you need to know about bonds, explained simply, step by step. By the end of this video, you'll understand bonds as clearly as you understand a savings account. Chapter 1. What is a bond? At its core, a bond is just a loan. You're the lender, and the borrower can be a government, a company, or even a local town. In exchange, the borrower promises two things: to pay you interest on a regular schedule, usually every 6 months, and to return your original money, called the principal, at a set date, called maturity. Bonds are very different from stocks. When you buy a stock, you're an owner. When you buy a bond, you're a lender. Chapter 2. Types of bonds. There are three main types of bonds you'll hear about most often: government bonds, corporate bonds, and municipal bonds. First, government bonds, like U.S. Treasuries. These are considered the safest because they're backed by the government, but their interest rates are usually lower. Second, corporate bonds. Companies issue these to raise money, and while they often pay higher interest, they also come with higher risk. And third, municipal bonds issued by states and cities. These often come with special tax advantages. Chapter 3. Maturities and structure. Bonds also differ in how long they last. Short-term bonds, intermediate bonds, and long-term bonds. Short-term bonds might mature in less than 3 years. Intermediate bonds in 5 to 10 years. And long-term bonds can go 20 or 30 years. Longer bonds tend to pay more interest, but they're also more sensitive to changes in interest rates. In the US, we also break treasuries into three groups: treasury bills, which mature in under a year, treasury notes, which last up to 10 years, and treasury bonds, which last more than 10 years. Chapter 4. Bonds versus CDs and savings. So why not just use a savings account or a certificate of deposit? CDs and savings are insured and super safe, but their interest is usually lower, and you can't sell a CD before maturity without a penalty. Bonds, on the other hand, can be traded in the market. That makes them more flexible, but it also means their prices can go up and down. Chapter 5. Taxes on bonds. One thing to keep in mind is how bond income is taxed. Interest from treasury bonds is exempt from state and local taxes. Treasury bonds are unique investments as they are exempt from state and local taxes, providing investors with a tax-efficient option to generate stable, long-term income while supporting government funding initiatives. Municipal bonds are a popular investment choice, often exempt from federal and state taxes, providing tax advantages for investors. These bonds help fund public projects and improve community infrastructure. That's why many high-income investors love municipal bonds. They keep more of what they earn. Corporate bonds interest, however, is fully taxable, which means investors must pay federal and often state taxes on the interest earned. This taxation can impact overall returns, making investor awareness crucial. Chapter 6. Pricing and Yield. Understanding bond pricing and investment yields. Now here's the part that confuses a lot of people: bond prices and bond yields. They move in opposite directions. Bond prices and yields are inversely related. If interest rates in the economy go up, the price of existing bonds goes down. Why? Imagine you're holding a bond paying 3%. Suddenly, new bonds pay 5%. Who wants your old bond? The only way to sell it is to cut the price so that its yield matches the new 5% market rate. The reverse is true when rates fall. Older bonds become more valuable. Chapter 7: Interest Rate Risk. In this chapter, let's talk about interest rate risk, one of the key things that affects bond prices. When interest rates rise, the market value of your existing bonds falls. Investors prefer new bonds that pay higher interest. If you hold your bond until maturity, you don't need to worry about price swings. You'll still get your full principal and interest payments. But if you sell before maturity, interest rate risk matters. Your bond's price could be lower if rates have gone up. Chapter 8: Credit Risk. The other big risk in bond investing is credit risk, the chance that the borrower doesn't pay you back. When you buy a bond, you're essentially lending money. If the borrower runs into financial trouble, they might delay or even stop paying interest and principal. That's why bonds have ratings. Independent rating agencies like Standard & Poor's, Moody's, and Fitch evaluate how likely it is that a borrower will repay its debt. AAA-rated bonds are considered the safest. They belong to stable governments or large corporations. On the other end of the scale are junk bonds. These pay higher interest, but they carry much more risk because the issuer might default. In simple terms, higher risk means higher potential reward. Investors earn more interest to compensate for the extra uncertainty. So before you invest in a bond, always check its credit rating. It's a quick way to judge how trustworthy the borrower is and how safe your investment might be. Chapter 9: Total Return. When you invest in bonds, your return comes from two sources: the interest you earn along the way and any change in the bond's price if you sell it before maturity. Together, that's called total return. Chapter 10: Duration. In this chapter, let's talk about duration, an important idea in bond investing. Duration doesn't mean how long a bond lasts. It tells us how much a bond's price will move when interest rates change. Let's say a bond has a duration of 5. If interest rates go up by 1%, the bond's price will drop by about 5%. So the higher the duration, the more sensitive the bond is to rate changes. It's a quick way to understand how risky a bond might be. Chapter 11: Why hold bonds? So why invest in bonds at all? Because bonds help smooth out the ups and downs of the stock market. Bonds provide stability, predictable income, and help reduce portfolio volatility. Bonds make your portfolio more stable and less risky overall. That's especially important for retirees who need steady cash flow. Chapter 12: Strategies. Now let's talk about how you can invest in bonds. Some people invest a lump sum, putting all their money in at once. Others invest gradually, a bit at a time. This is called dollar cost averaging. Both can work well. It depends on your comfort with risk and timing. Chapter 13: Inflation Protected Bonds. Some bonds are built to protect you from inflation. They're called TIPS, Treasury Inflation Protected Securities. As inflation rises, the bond's value also increases. That means your money keeps its purchasing power over time. Another option is I bonds. They also adjust with inflation, but have limits on how much you can buy each year. Chapter 14: Building a Bond Portfolio. When building a bond portfolio, think about your age, risk tolerance, and goals. Let's talk about few strategies to build a bond portfolio. Laddering strategy. A popular strategy is bond laddering, buying bonds that mature at different times, so you always have some money coming due. Funds and ETFs. If you don't want to manage individual bonds, then you can go for bond mutual funds and ETFs. They are an easy way to get instant diversification. Whether you build your own ladder or invest through a fund, bonds can help you create steady income and reduce overall risk. Chapter 15: Bonds in Retirement. In retirement, bonds can play a very important role. They provide a steady stream of income, so you can rely on regular payments. Bonds also help protect your savings when the stock market is volatile. A balanced portfolio of stocks and bonds helps retirees enjoy stability while still allowing for growth. So there you have it, bonds explained. Remember, bonds are loans, not ownership. Their prices move opposite interest rates. They carry risks like credit and inflation, but they also provide stability and income. Add them wisely to your portfolio, and they can play a key role in your financial journey. If you found this video helpful, make sure to like, subscribe, and share this video with someone who wants to learn about bonds investing.